So restricted stock units are really just another form of compensation. A company will say instead of paying you a salary, we're going to give you company stock in lieu of the compensation. So the timeline is really kind of keyed on a couple dates. So there's a grant date and a vest date. The grant date is essentially when the company says, all right, we're going to give you X amount of shares of our company stock. So let's say the company gives you 50 shares of their company stock on the grant date. Well, they also have a vesting schedule, which means you have to wait a certain amount of time before that stock is actually yours. So most companies offer a 4-year vesting schedule. So let's say in this example, we have 50 shares, 4 years goes by. Okay, now we vest, and that 50 shares is worth $10,000. Okay, so you have the option to sell that now. So basically, at your vest date, you're going to be paying ordinary income taxes on the $10,000. If you sell it right then, you're paying taxes on the $10,000 and nothing else. Now, if you decide to hold the stock and the stock increases in price, and let's say you sell it within the year here, and it goes up to $12,000, you're paying taxes on just the $2,000 gain. And because you've held it less than a year, you're paying, once again, ordinary income tax rates on just the $2,000 gain. Now, if you sell it after a year, and let's say it's still $12,000 at that point, you're paying capital gains rates on the $2,000. So that's usually the 15 or the 20% rate. So that in a nutshell is how RSUs work.